All right, let's dive straight into this explainer. We're looking at how a massive transfer of power at the world's most powerful central bank is frankly a direct threat to your personal savings. Just picture it. It's 9 a.m. in Washington, and an outgoing leader is handing over the keys to the Federal Reserve. And look, this isn't just your standard changing of the guard. No, it's a monumental shift that's going to ripple right through global markets, straight into the cash sitting in your checking account. We're talking about a move that could fundamentally alter the actual price of our money and the future of our investments. So grab a coffee, get comfortable, and let's break down exactly what this hidden danger is, and more importantly, how you can navigate it. You've really got to listen closely to the exact phrasing used by the incoming Fed leader, Kevin Warsh. He didn't stand up in front of the US Senate and say he wanted to make a few minor policy adjustments. He didn't even say he wanted a reform. No, he stated completely unequivocally, "I want a regime change." Think about that. Those words carry an absolute ton of weight in the central banking world. A regime change implies a dramatic, foundational shift in how the value of our money is managed. It basically signals that the rulebook we've been operating under for the past few years, yeah, it's about to be tossed right out the window. Section 1. A regime change. To really grasp the sheer magnitude of this shift, we have to look at the stark contrast between the outgoing leadership and the new regime taking over in Washington. Contrast the outgoing Jerome Powell, who, largely represented the institutional status quo, with Kevin Warsh. Warsh is definitely not your typical academic economist. He actually spent 15 years as the right-hand man to Stanley Druckenmiller, literally one of the most successful hedge fund managers on the planet. So he spent a decade and a half figuring out exactly how to profit from Federal Reserve decisions. And now, well, he's the one actually making those decisions. What's wild is that during his confirmation hearings, when asked about the 2020 election results, he declined to give a direct answer. The markets instantly took that as a massive signal regarding the central bank's future political independence.
Section 2. What is financial repression?
Now, to understand the hidden threat behind this transition and what Warsh's regime change actually means for us, we have to look back about 80 years to a very specific macroeconomic tactic: financial repression. Back in 1946, right after World War II, the U.S. had a massive, massive debt problem. We're talking debt at 106% of GDP. But by 1974, that debt had magically shrunken down to just 25%. How on earth did they pull that off? Well, they didn't pay it off. That would have been way too hard. Instead, they used financial repression. The government intentionally kept interest rates artificially lower than inflation for decades. What that does is effectively force everyday citizens, banks, and pension funds to lend money to the government at a guaranteed loss. It's a way to quietly erase massive national debt by secretly eroding your purchasing power. The state gets richer, and basically anyone holding cash gets poorer. And when you compare then and now, it's honestly pretty chilling. Unlike 1946, when that huge debt was safely locked into 20- and 30-year fixed-rate bonds, today's debt profile is a totally different beast. Today, the U.S. debt sits at a staggering 125% of GDP. But here is the truly terrifying detail. Almost half of that debt expires and needs to be refinanced within one single year. So today's debt isn't some stable, long-term obligation. It's a ticking time bomb of short-term variables. Put simply, the U.S. essentially has an exploding $39 trillion variable rate mortgage. If interest rates don't come down, the annual payments on this debt are going to absolutely skyrocket. I mean, already, the U.S. government is paying over $1 trillion a year just in interest. That is more than they spend on the entire national defense budget. This pure mathematical reality means the new Fed regime essentially has zero choice. They absolutely must bring rates down at all costs just to avoid bankrupting the whole system. Section 3. The three-step plan. So to stop these suffocating debt payments from totally collapsing the economy, Warsh has mapped out a highly specific strategy. The blueprint has 3 steps. Step 1. Forcefully slash short-term interest rates down to around 2.75%, pushing them a full percentage point below current inflation levels. Boom, that's financial repression in action. Step 2. Offload roughly $7 trillion in assets, like mortgage-backed securities, that are currently just sitting on the Fed's balance sheet. And step 3, this is the wild card, rely on artificial intelligence. The thesis he actually presented to the Senate is that AI will lower corporate costs enough to magically offset the inflation caused by cutting those rates. It's an absolutely unprecedented gamble on emerging technology. But here's the crack in the plan, and honestly, it's a fatal flaw. While the Fed is busy cutting those short-term interest rates to save the government's budget, their massive $7 trillion asset sell-off has the exact opposite effect on the long end of the market. You see, when a central bank dumps long-term assets, 10-year yields and mortgage rates actually go up, not down. And the market is already silently reacting to this. We're seeing a weird dynamic where short-term rates drop, but long-term borrowing costs for everyday people and businesses are secretly climbing higher.
Section 4. The geopolitical and local impact.
Now, you might be sitting there wondering, okay, this Washington debt math is fascinating, but why does this matter to me if I live in Europe, or say specifically in Italy? Well, let's connect the dots here. A central bank's independence is really the only wall protecting your money from politicians. Back in 1948, Fed Chair Marner Eccles famously fought off President Truman to keep the bank independent. But look at 1969. Fed Chair Arthur Burns yielded to political pressure from Richard Nixon, basically providing easy money right before an election. And the result? Inflation skyrocketed to 13.5% by 1980, completely wiping out an entire generation of careful savers. Fast forward to 2026, and the Powell versus Warsh transition marks the start of a brand new political battle over that exact same independence. And history proves, time and again, that when politics wins, inflation always follows.
Because the US dollar is the global reserve currency, whatever happens there dictates the baseline everywhere else. It's just the physics of money. If US 10-year yields spike up to 5% because of this asset sell-off, well, Italian 10-year bonds, BTPs, they must be dragged up right alongside them. Think about it. Why would any global investor lend money to Italy at 3% if they can get a totally risk-free 5% from the US government? They wouldn't. So when Italian bond yields rise, the local government has to pay a lot more to finance its own debt. And how do they pay for that? Yep, by passing the bill directly to you. We're talking higher local taxes, degrading public services, and weaker pensions. You essentially end up paying the price for Washington's regime change.
Section 5. The 4 defense coordinates. So the situation is complex, for sure, but we are not defenseless here. While the general public remains completely in the dark about this creeping financial repression, the smart money is already executing a very sophisticated escape plan. And this shift is happening on a massive scale. Data from a recent JP Morgan report actually tracks billionaire family offices. These are the folks managing the world's most vital private wealth. And they are actively fleeing stagnant cash. They're aggressively reducing their exposure to the US dollar, moving a massive 60% of their portfolios into alternative hard assets. We're talking real estate, private funds, and gold, all to shield themselves from that erosion of purchasing power. The smart money simply isn't waiting around to become a victim of financial repression. But hey, you don't need to be a billionaire to build your own defense. You can use these exact same 4 coordinates. Coordinate 1, manage your liquidity. Seriously, do not leave your cash just rotting in a 0% bank account while inflation eats it alive. Move it into yielding short-term instruments like monetary ETFs or short-term bonds. Coordinate 2, if you hold global index funds, maybe consider currency-hedged versions. That protects your portfolio against a deliberate weakening of the dollar. Coordinate 3, gold. Look, in a world of central bank regime changes, holding a percentage of gold isn't some get-rich-quick scheme. It's pure, simple monetary insurance. And finally, coordinate 4. Keep a very close eye on your variable mortgages. While U.S. mortgage rates might rise, European rates are tied to the ECB, which might just follow a different path. We've covered a whole lot of ground in this explainer today. The reality is, we cannot control the Federal Reserve, we can't control government debt, and we certainly can't control these shifting geopolitical tides. But armed with this awareness, you are no longer in the dark. The rules of the game are absolutely changing, and financial repression is quietly shifting wealth away from passive savers. So I'm going to leave you with this final, vital question to think about. Knowing what you know right now, what will you choose to do today to protect your wealth for tomorrow? Thanks for joining me on this explainer, and stay curious.